Marcus, Ethan, and Daniel all started with exactly the same opportunity. They were 28 years old. They lived in Dallas. Each earned $75,000 a year. Each had managed to save their first $30,000. And each made the same promise to themselves. This money wasn't for a vacation. It wasn't for a new truck. It was supposed to build wealth. Then they made three completely different decisions. Marcus became a day trader. Every morning before work, every lunch break, every evening, he watched charts. His goal was simple: buy, sell, repeat. Capture small moves every single day. Ethan chose swing trading. He didn't care about minute-by-minute price movements. He looked for trends that lasted days or weeks. Fewer trades, bigger moves. Less time glued to a screen. Daniel ignored both of them. He bought a low-cost index fund and set up an automatic investment every month. Then he went back to living his life. 3 different strategies. 3 people who all believed they'd found the smartest path. Here's the strange part. If you asked each of them after the first year, every single one would tell you they made the right decision. And they'd all have a convincing story. Marcus would show you screenshots of trades that made $900 before lunch. Ethan would point to a swing trade that earned 14% in 3 weeks. Daniel would quietly open an app showing steady gains while admitting he barely checked it. 3 different stories. 3 different definitions of success. But here's what almost nobody does. Nobody runs every number. Not just the returns. Everything. Taxes. Trading costs. Missed work. Opportunity cost. Cash sitting on the sidelines. The cost of being wrong. The cost of being emotional. The cost of trying to be smarter than millions of investors around the world. Because once you include every one of those numbers, something unexpected happens. The strategy that looks exciting begins losing ground. The strategy that looks boring quietly starts catching up. And one decision creates a gap so large that it changes retirement, financial freedom, and even how much stress these 3 people carry every single day. The surprising part? The winner isn't decided by who makes the biggest trade. It's decided by who keeps the most money after everything else. That's the math most people never see. So let's make this comparison as fair as possible. Marcus, Ethan, and Daniel all start with exactly $30,000. They each invest another $1,000 every month. Same income, same city, same age, no inheritances, no lucky crypto bets, no millionaire uncle handing out investment tips. The only thing that changes is how they invest. Marcus spends roughly 3 hours every weekday studying charts and placing trades. He's averaging around 220 trades every month across stocks and ETFs. His goal is ambitious. He believes he can earn about 18% a year before costs because he only needs to capture small price movements over and over again. Ethan has a different philosophy. He places about 8 to 12 trades each month. He holds positions anywhere from several days to several weeks. His target isn't home runs. He's aiming for roughly 12% annual returns before costs, while avoiding the chaos of daily trading. Daniel makes exactly one decision. He buys shares of a broadly diversified index fund, tracking the U.S. stock market. Every month, another $1,000 goes in automatically. He expects something close to the market's long-term average. Nothing exciting, nothing dramatic, no predictions, just consistency. Now ask yourself something. Which one sounds the smartest? For many people, Marcus immediately feels like the winner. He's active. He's learning. He's watching financial news. He's making decisions. He's doing something. Daniel almost feels lazy by comparison. His investment grows while he sleeps. He doesn't watch CNBC all day. He doesn't spend weekends analyzing candlestick patterns. He doesn't brag about today's winning trade. Feelings and math are 2 very different things. The market doesn't pay you because you worked harder. It pays you based on what you actually keep. That difference matters more than most people realize. Let's fast forward 1 year. Marcus has an incredible story. His trading account grew by 17% before taxes. His original $30,000 plus monthly contributions should have become roughly $48,000. On paper, that's impressive. Sounds great until you subtract everything else. Marcus made hundreds of trades. Even with today's low-commission brokers, every trade crossed a bid-ask spread. Think of that spread as a tiny hidden transaction cost. Maybe 5 cents here, 10 cents there. Across roughly 2,600 trades in a year, those tiny costs quietly added up to around $1,500. Then came slippage. That's when the price moves slightly before your order executes. Another hidden expense. Conservatively, that cost Marcus another $900. Then taxes arrived. Because most of his positions were held for less than a year, nearly all of his gains qualified as short-term capital gains. In the United States, short-term gains are generally taxed at ordinary income tax rates, according to IRS rules, not the lower long-term capital gains rates. Marcus suddenly watched thousands of dollars disappear before he ever spent them. His impressive gain looked much smaller. Meanwhile, Ethan finished the year with fewer stories. His account earned about 11%. His balance reached roughly $45,500 before taxes. He only placed around 120 trades all year. His trading costs were dramatically lower. His bid-ask spreads and occasional slippage totaled roughly $350. Still real, still important, but nowhere near Marcus's costs. Some of Ethan's profitable trades stayed open long enough to qualify for better tax treatment later, although many were still short-term. His after-cost results remained respectable. Then there's Daniel. Daniel's account grew around 10%. His balance reached approximately $45,000. Not spectacular, not headline-worthy. His fund-expense ratio? Around 0.14 and 3%. On a portfolio his size, that's only a few dollars. He didn't generate taxable events because he didn't sell anything. He simply kept buying every month. At this point, Marcus smiles. I'm still winning. And technically, he's right. For now, year one belongs to the active trader, at least on the surface. But investing isn't a one-year game. It's a game where small differences repeat again and again and again. By the time year 3 arrives, the story begins changing in a way almost nobody notices until it's too late. By the end of year 3, Marcus still had plenty of screenshots. There was the biotech stock that jumped 22% in a single afternoon, the semiconductor trade that earned him almost $3,400 in 4 days, the earnings play that looked like pure genius, until the next earnings play erased most of those gains. His trading account had grown, but not in the smooth upward line he imagined when he started. It looked more like a heartbeat. Up, down, up again, then a sharp drop, then another recovery. Before costs, Marcus had averaged about 15% annually over the first 3 years. That sounds phenomenal. Starting with $30,000 and adding $1,000 every month, his account should have been worth around $89,000. On paper, that's fantastic. Sounds great until you subtract everything else. His annual trading friction never disappeared. Bid-ask spreads still averaged around $1,400 to $1,800 each year. Slippage quietly consumed another $800 to $1,240. Real-time data subscriptions, charting software, and trading platforms cost roughly $700 to $1,500 annually, depending on the tools he used. Then came taxes. Because Marcus realized gains almost every year instead of allowing them to compound, untouched, thousands of dollars left his portfolio before they ever had the chance to earn future returns. After accounting for those costs, his effective annual return wasn't anywhere close to the 15% he talked about. It was closer to 10% to 11%. His portfolio now sat around $82,000. Still good, just not nearly as good as the headline number suggested. Ethan's journey looked much quieter. He rarely experienced the emotional highs Marcus chased. He wasn't making 10 decisions every day. Instead, he waited. Sometimes an entire week passed without placing a single trade. His average return before costs came in around 11% annually. His account reached roughly $84,000 before taxes and expenses. Trading costs remained modest, about $300 to $500 each year in spreads and occasional slippage. His software expenses were lower too. He wasn't paying for multiple news terminals or advanced intraday scanners. After everything, Ethan's portfolio was worth roughly $81,000. Suddenly, the gap between Marcus and Ethan had almost disappeared. 3 years of extra effort, thousands of additional trades, hundreds of extra hours, and only about $1,000 separated them. Then there was Daniel. Daniel almost forgot to check his account. His automatic investments continued every month. The market had good months, bad months, a correction, a recovery. He kept buying through all of it. His annual return averaged close to 10%. His portfolio reached approximately $82,000, nearly identical to Marcus, nearly identical to Ethan, except one detail nobody notices. Daniel hadn't paid meaningful capital gains taxes because he hadn't been selling. His investments continued compounding without interruption. That may not sound important. It becomes incredibly important later, because every dollar that stays invested has the opportunity to earn returns on top of previous returns. That's compound growth. And compound growth works best when nothing interrupts it. Now something interesting begins happening. Marcus notices Daniel's account. He laughs. "You made almost the same amount doing nothing?" Daniel shrugs. "I wouldn't call it nothing." He's right. Doing nothing is often one of the hardest investing decisions, especially when everyone around you is talking about the next hot stock, especially when financial television makes it feel like every hour requires a new decision. The Securities and Exchange Commission has repeatedly reminded investors that higher trading activity doesn't guarantee higher investment performance. Trading more simply creates more opportunities for costs and mistakes. And that's an uncomfortable fact, because activity feels productive. Productivity and profitability are not always the same thing. By year 5, the differences become impossible to ignore. Marcus has become a much better trader. He's more disciplined. He cuts losses faster. He avoids chasing momentum as often. His skill genuinely improved. This comparison isn't assuming Marcus is reckless. He's competent. That's what makes the numbers interesting. Before costs, he's averaging about 14% annually. His account should now be approaching $143,000. Sounds incredible, until you subtract everything else. 5 years of taxes, 5 years of spreads, 5 years of slippage, 5 years of software, 5 years of cash sitting on the sidelines while he waited for the perfect setup. That last one hurts the most. Opportunity cost rarely appears on an account statement, but it's real. Suppose Marcus keeps an average of $8,000 in cash waiting for trading opportunities. If the market returns roughly 10% during a strong year, that idle cash missed approximately $800 of growth. Repeat that across multiple years. The missing gains begin stacking on top of each other. Not because he lost money, because the money never had the chance to grow. After every friction cost, Marcus's portfolio stands around $130,000. Still impressive, still wealth, just much lower than the return he advertises. Ethan reaches approximately $127,000 after costs. He's only a few $1,000s behind Marcus, despite making fewer than 1/20th as many trades. Daniel quietly reaches roughly $128,000. He has now caught both of them, not because he found a secret investment, not because he predicted the economy, because almost every dollar stayed invested, almost every dollar stayed compounding. This is the flip point. It's subtle. Nobody posts about it online. Nobody celebrates it on social media. There's no dramatic chart, no viral screenshot. Just mathematics slowly taking control of the story. Marcus spent thousands of hours trying to outperform the market. Daniel spent those hours building new skills at work, spending time with family, exercising, or simply living. That's another opportunity cost almost nobody measures. Time. 3 hours every weekday equals roughly 750 hours every year. Over 5 years, Marcus devoted nearly 3,700 hours to trading. That's the equivalent of more than 1.5 full-time working years. Now maybe Marcus enjoys trading. If he genuinely loves it, that time has value beyond money. But if his only goal was maximizing wealth, those hours deserve to be counted. Suppose instead he used even a portion of that time to earn a professional certification, leading to a $7,000 annual raise. Over the next 15 years, ignoring promotions and investment growth, that single decision could produce over $100,000 in additional income. Again, not guaranteed, but it's a real opportunity cost. Money isn't the only resource you're investing. Attention is too, and attention is finite. This is where the conversation usually goes off the rails online. One person says, day trading is gambling. Another replies, index investors are lazy. Neither statement helps you. The truth is more complicated. Some day traders are consistently profitable. Some swing traders outperform the market for long periods. Some index investors panic during bear markets and sell at exactly the wrong time. Your strategy matters, but your behavior matters even more. That's why the biggest number in investing often isn't your return. It's the return you actually keep. And to understand why that gap keeps growing over the next decade, you have to look at the hidden costs almost nobody includes when they're showing off their investing results. That's where the conversation usually changes. People love talking about returns. Very few people talk about what those returns actually cost. If I told you Marcus made 18% in a year, it sounds incredible. If I told you he kept only 11% after taxes, trading friction, and cash sitting on the sidelines, the story suddenly feels very different. That's the number almost nobody posts. Let's slow down and look at the hidden layers one at a time. The first is taxes. This is probably the biggest advantage Daniel never has to think about. Marcus is constantly realizing gains. Every profitable trade creates a taxable event. According to IRS rules, assets held for 1 year or less generally receive short-term capital gains treatment, which is typically taxed at ordinary income tax rates. Daniel, on the other hand, keeps buying. He isn't selling. That means much of his money continues compounding before taxes are eventually due. That difference compounds year after year. The second hidden cost is slippage. It sounds technical, but it's simple. You click buy at one price. Your order fills a few cents higher. Or you click sell. Your order fills slightly lower. A few pennies don't matter, until they happen thousands of times. Marcus experiences this nearly every trading day. Daniel almost never notices it. The third hidden cost is the bid-ask spread. Every security has buyers and sellers. The difference between those prices is the spread. Crossing that spread over and over again quietly transfers money out of your account. It's invisible. But invisible doesn't mean free. Then there's software, professional charting platforms, real-time market data, options analytics, news feeds, trade scanners. Maybe they're worth every dollar, but they're still costs. Marcus spends roughly $1,000 a year to stay competitive. Daniel's annual fund expense ratio is only a few basis points. On his portfolio, that works out to just a handful of dollars. The fifth hidden cost is emotional mistakes. This one never appears on an account statement, but it might be the most expensive of all. After 3 winning trades, Marcus feels unstoppable. After 3 losing trades, he starts questioning his system. Sometimes he exits too early. Sometimes he holds too long. Sometimes he forces trades simply because he's been staring at charts for hours. Daniel faces a different challenge. During market corrections, he watches his account fall thousands of dollars. He has to resist the urge to stop investing. Both strategies demand discipline, just different kinds of discipline. Now let's fast forward another 5 years. Year 10. Marcus has become genuinely skilled. He's survived long enough to avoid many beginner mistakes. His average gross return settles around 13% annually, starting with $30,000 and investing another $1,000 every month. That portfolio should be worth roughly $330,000 before costs. Sounds fantastic. Until you subtract everything else. A decade of taxes, a decade of spreads, a decade of slippage, a decade of software, a decade of opportunity cost. His portfolio finishes at approximately $290,000. Still excellent. Still far ahead of where he started. Just not nearly as high as the number people hear first. Ethan continues doing what he's always done. Patient entries, patient exits, limited trading. His portfolio reaches roughly $300,000 after costs. For the first time, he quietly moves ahead of Marcus. Not because he earned dramatically higher returns, because he kept more of what he earned. Daniel keeps buying every month. Bull markets, bear markets, election years, recessions, recoveries. He buys through all of them. His portfolio reaches approximately $310,000. No predictions, no market timing. Just uninterrupted compounding. This is the point where many viewers expect me to declare that index investing is the only intelligent strategy. But if I only showed you the downsides of day trading, I'd be doing exactly what every index fund influencer criticizes active traders for doing. That wouldn't be fair, because there are absolutely situations where active trading wins. If you're one of the small percentage of traders with a tested system, strict risk management, and years of consistent execution, your results can exceed the market. If trading is your full-time profession, rather than your retirement strategy, the comparison changes entirely. If you're managing risk across multiple asset classes or using institutional-level tools, active trading becomes a different game. And if your taxable income is unusually low in a given year, realizing gains may have a much smaller tax impact than expected. Those are real advantages. They're just not the average experience. The same fairness applies to Daniel's strategy. Index investing isn't perfect. It guarantees you'll experience every market crash. When the market falls 30%, your portfolio falls too. There's nowhere to hide. It also requires patience that many people underestimate. Watching 6 figures temporarily disappear without touching your investments isn't easy. And if you need your money during a major downturn, timing can become a serious problem. Every strategy has weaknesses. The goal isn't finding perfection. It's understanding the trade-offs before you commit. Now let's stretch the timeline to 20 years, because that's where compounding becomes impossible to ignore. Marcus continues earning respectable trading results. His account finishes around $980,000 after decades of costs and taxes. He's proud of what he built. He should be. Very few people save and invest consistently for 20 years. Ethan finishes with roughly $1.8 million. Lower trading frequency, lower friction, more money staying invested. Small differences repeated thousands of times. Daniel reaches approximately $1.22 million. No secret, no magic, just the markets. Long-term growth, combined with disciplined monthly investing and minimal costs. Now imagine changing just one variable. Instead of investing $1,000 every month, Daniel increases that contribution by only $200, not $2,000, not $500, just $200. Over 20 years, assuming similar long-term market returns, that small adjustment alone can add well over $150,000 to his ending portfolio. One small habit, repeated hundreds of times. That's how wealth is usually built. Not through one spectacular decision, through thousands of ordinary ones. So let's come back to where we started. Marcus, Ethan, and Daniel all walked away believing they made the smart play. Marcus believed working harder would naturally produce better returns. Ethan believed careful timing would outperform constant activity. Daniel believed consistency would eventually beat excitement. None of them were completely right. None of them were completely wrong. Because the real answer was hiding in the numbers they weren't looking at. The real trap isn't day trading. The real trap isn't swing trading. The real trap isn't index investing. The real trap is making a financial decision based on hype, headlines, or someone else's opinion, instead of running the numbers for your own situation. Because your taxes are different. Your income is different. Your risk tolerance is different. Your goals are different. And those differences change the math. If you're wondering what happens when someone combines these strategies, using index, investing as a foundation while allocating a small percentage to active trading, that's a completely different conversation. And it might surprise you even more. So before you make your next investment decision, ask yourself one question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.